do you think, right, that selecting a fund is a very demanding job? If you think yes, you can put yes, or you can put no. Identifying which fund to invest in, it's not an easy thing. We have to do research, figure out what funds, when to buy, when to sell, what all. There are a lot of activity which are involved. I'm presuming most of you are going to say yes, the way we are seeing the audience. Great. So we agree with all of you. And it's not only demanding, but we have to spend lot of time, effort, energy in figuring out which fund to select in. Now let me ask another question. I mean, you don't have to answer this, but if you wish, you can. How many of us, I'm talking about our partners here, have a proper process, right? If you have a process, you can type P. If you're not, it's okay. That you have a certain process where you follow certain parameters and you follow it diligently, month on month, quarter on quarter, to suggest something to your fund. Right. So, all right. I can imagine that, because it's for people who are saying no, popular saying yes, great. We really appreciate that. And people who are saying no, we can imagine the effort goes. Because I think we understand that for most of the partners here, the most important constituent of their entire business is not market knowledge, is not product knowledge, is not technology, but it is a customer relationship, right? Our whole objective here is to build a very process, build a fund selection process, is to ensure that you are able to spend most of your time with customer and less time in all of these activities. And that's the reason we have a platform. We have all the other things, and now we are also talking about the research we have, wherein if you don't have to worry about the fund selection process, which we will take care of. So you can spend more and more time with the customer. However, we also understand that before you suggest the fund recommendation which we are asking you, you should also be comfortable and convinced of what we are doing. And that's why we are here today. So with this, let me start the session. This is this is our fund selection process, which we are going to share with you. All right. Now, before we talk, just give me 1 second. Yeah. All right. As so I'd just like to highlight the team behind this. So it's a 6-member team who is working behind the fund selection process, right? I'm sure all of you know our founder Vishant, who is an IT Chennai graduate, right? I'm also responsible investment strategy, and I have worked in product function of mutual fund companies like Principal and Pramerica in my earlier career. We have a very senior person who analyzes the data. His name is Vetri. And then we have Anushi, Sai, Asana, and Shreya, who are all specialist investments. So this is a team who is bringing to you this entire investment process. Now, what really happens behind the process, right? And as many of you mentioned, the demanding job it is. So here, I would like to share something with you. We have spent almost 250 hours to build this entire process, and it happened one time, but every quarter, every half year, every year, this entire thing is very dynamic, and we have to keep on adding more and more. We also learn, and we keep on improvising on what we have done. Then we have analyzed almost 1 crore data points, right, to ascertain where we are. And once I show some of the information to you, you'll realize. I'm presuming that many of you have received our document called Know Your Fund document, wherein we have given very interesting. We have created very interesting 1-pagers on all the funds we have suggested. And as far as the team is concerned, the entire team who's behind the fund selection process has more than 50 years of collective experience. We are using multiple softwares. We are using programming language Python. We are using Tableau for representation, and of course, we are using ASMF, which is an industry data software, to help us in, so that we have every information and tech to available for us to do this. And I think this also proves the points of most of our partners here, that what is the effort required in building all of this, right? Now, moving on to first, equity and hybrid funds. I'm sure all of you are eagerly waiting for it. We are also going to touch upon debt funds for a brief period, but this is where I think the process becomes most important, right? I'm sure most of you are waiting for this. So what are we doing? So we only have 3 slides where I'm going to explain about the entire process which we have. I'm also going to share with you some of the past recommendations and how they have done, right? And then I'll take a couple of minutes to explain about the debt funds also. So let's start with equity and hybrid funds. Okay. Now, there is a process which we have, but that process comes from a certain philosophy. Like all of us have a certain idea of in life, and that idea turns into principles and processes. So what is our core fund selection process? Our philosophy. So these are 6 things which I would like to share about. Number one is fiduciary responsibility. What does it imply? That when I am giving this recommendation to you, and when you are giving the recommendation to your client, there is a fiduciary responsibility in this. These are matters of finance, and it can have a huge impact on individuals' life goals. So therefore, we understand and appreciate the fiduciary responsibility all of us carry. Right? It's a position of a trust. It's not that we are selling some cloth or selling some mobile or selling some food wherein once or twice wrong it doesn't matter. But here we are cognizant of the fact that we have a very critical fiduciary responsibility. Number two, risk management. देखिए, the way I have understood in my 20 years of career, the way equity investing works is, if you take care of the risk, the returns will follow, right? So when we talk about returns, I'm more concerned about risk than about returns. Being in market for so long, and now we have data for decades, controlling the risk is more important than trying to chase the performance. Number three, longevity. All of us talk about investing for 5 years, 10 years, 20 years. I'm sure you are suggesting your clients to do SIP for 5 years, 10 years, 20 years. So therefore, whatever we are recommending, we also understand that it has to have a very long-term bias. The fourth one is very important, and it actually comes from our philosophy of avoiding risk and being longevity and giving a long-term call. So we tend to avoid sector funds, not because there is anything wrong with sector funds per se, but the issue in sectoral fund is, if it goes wrong, then there could be 5, 10, 15 years of period when the fund or when the sector continues to underperform. I'm sure all of you have all of you will remember IT. Some of you might remember real estate. Some of you might remember tech bubble. So for 10 years, the funds don't come to their peak. So we tend to avoid. As an individual, you can suggest, there is no problem in that. But as an organization, we have decided that as of now, we are not going to recommend you anything on the sectoral funds. Then we look at combination of quantitative and qualitative factors. For us, quantitative criteria is very, very important, but it's not the only thing. And then finally, we also look at a significant amount of diversification between AMCs and schemes. So you will see I'm sure all of you have seen our recommendations, wherein for this month, for this quarter, we have recommended 53 equity and hybrid funds, which are coming from 19 different mutual fund companies, right? So we not only consider the scheme level diversification, but we also consider the AMC level diversification. So these are the 6 pillars of our investment philosophy. Now, what does that translate into, right? This is perhaps the most important slide of our entire presentation, that how are we doing the elimination, right? So eventually, frankly, if you ask me, it is more about elimination than about selection. And why? Because of this. As you can see, just give me 1 second. Yeah, so there are more than, okay, well, I think there is, yeah, I'm sorry. Cool. I'll talk about why elimination. First of all, what we do in the process is, well, we look at all the equity and hybrid funds, and we exclude sectorial, thematic, and passive funds. That is number one, which we do. Then we eliminate all the schemes which have less than 3 years of experience and less than 500 crore of AUM, right? There could be an exceptions here and there, but largely speaking, we will tend to remove the schemes which have less than 3 years of experience, existence, or less than 500 crore of AUM. Then we look at the performance criteria, wherein we not only look at point-to-point performance, we are concerned about consistency of performance, and we are concerned about the downside protection, right? Then once we shortlist or once we have an eliminated list, then we look at some of the qualitative criteria, which is the diversification and what is the fund house pedigree, and then we come out with the final list. Now, I will also give you the numbers, that what are all numbers when it comes about when we start looking at our elimination process. But before that, let me take 2 minutes and explain what do we mean by performance and downside. What do we mean by performance consistency, and what do we mean by downside protection? In performance, we look at 2 things. we obviously look at how the fund has performed versus benchmark. We don't benchmark against category because category is a moving thing, right? Sometimes there is a new fund in the category. Sometimes the funds can take extraordinary high risk in the category. Sometimes the categories change. So we don't look at a moving target. We look at benchmark. And number two, we not only look at how much we not only look at whether the fund has outperformed or not, we also look at if the fund has outperformed, how much it has outperformed, and if the fund has underperformed, how less it has outperformed, right? So number of time the fund has outperformed and the quantum of the outperformance or underperformance. Then we statistically look at the downside. What we need to see is, we all know that equity markets are always going to be volatile. There are always going to be time when the markets are going to go down, then they're going to come up. This cycle will continue endlessly with the upward bias. We look at the fund, we look at the maximum drawdown. If the markets have gone down, how much the how much the fund has gone down, and when the market is recovered, how much time the fund has taken to recover. For example, let's say during COVID times, if a fund has gone down by 10%, and let's say A fund has gone down by 30%, and it recovered in 6 months, and let's say B fund went down by 30%, but it took 8 months to recover. In that case, I will assign a slightly better rank to the fund which has recovered earlier. So we have created a statistical model. All of that we put into the model, and it throws out the number for us. Now, I think this is very interesting. This is a fourth slide I'm talking. This is a third or fourth slide of the equity process. So let's look at the number of funds where we start with and where we end with. So would anyone like to guess the number of open-ended equity and hybrid funds in India? 3,000. Okay. Open-ended. Okay. Well, that's a total number of funds, but the number of again, there is one problem system. Oh, all right. Okay. So there are about 866 funds in equity and hybrid category, right? Then once we remove the categories, like mentioned, we are removing we are removing the categories like we are removing categories like sector funds, passive funds, right? Once we remove a fund of funds, for example, then we are left with 337 funds still. Then our elimination filter, which if you recollect is about 500 crores and 3 years of existence. Once you do that, we are left with about 208 funds. Then we have shown you our performance and a downside protection filter. After that filter, we look at the top 20% funds basis our own analysis. If you do it, it will not come right because we have a certain ranking system. So I look at the top 20% funds. That leads me to about 68 funds. Then we have modified about 15 funds for different parameters, and then finally we are left with about 53 funds. I'm sure you would have seen the document. If not, I will just mention my email ID and number, and then we will share that document with you. I will share the document with you right after this call. So, in fact, what you can do, my colleague Aditi is going to put she is going to put our WhatsApp number in this. We have a WhatsApp community. Once you subscribe to that community, you will start getting all our updates. I will share this presentation plus our Know Your Fund presentation, which has name of all the funds and one pager on all the funds about why we have chosen that fund, what are the fund performance, rolling returns, etc. All of them are available. So please subscribe to that link and you can see it there also. Otherwise, you can send us an email or you can talk to our RM. They will be able to share it with you. So this, dear friends, this is the entire process which we are following, right? I'm sure this will give you some understanding, some broad idea of how we are doing it. But more importantly, what I want to come and tell you is that even though I am from this industry, we have some team members who have spent 15 years, 20 years in the industry. We don't go by intuition or by gut feeling. We have a process and we are going to follow that process. Frankly, if you ask me for my suggestions, some of the funds are here which I might not recommend, but we don't want to bring our personal bias, because we have seen if I bring my personal bias, there are going to be times when the system is not going to work, right? So therefore, we want to follow a process, which is what I wanted to share with you. And I'm very happy that within the team, we have been able to come out with a process which we think can really help our partners and stop in the not worrying about the funds, which fund to select. They can just go look at our recommendation, and then from that recommendation you can get a portfolio of your investors. What we are also doing is creating a note, or we are creating a framework of how can you construct the portfolio. That will take about 1 or 2 months for us. So the next step for us to create the portfolio construction process, but that will come after some time. Excuse me. Right now, I would like to share some of the performance of our previously recommended funds. Right, I have taken 2019 as a cutoff date because we need to wait at least 2-3 years for the fund to show performance. So there are about 10-11 funds which I'm showing here, and you can see that it's not that we have outperformed in all the funds, right? There are funds where we have outperformed significantly. There are funds where we have underperformed. Like for example, Kotak Flexi Cap, we suggested it has delivered 13.2% returns on SIP and 13.94% return on the benchmark. So it has underperformed. So please, sir, what we are trying to say is, it's not that if I am going to suggest you 50 funds, all of them are going to beat the benchmark. No, that is not going to happen. It's a dream, but that may not turn out to be a reality. However, most of the funds, if you see, have outperformed in general, and our average outperformance has been more than 2 to 3%. So if somebody makes a basket of the benchmark and the baskets of funds which we are recommending, the fund what we are recommending tends to outperform by about 3% on a even on a medium term basis. So I think that is the point which I want to bring home, that no matter what process we follow, there are going to be funds which are going to underperform. There are going to be a lot of funds which will do average, and there are going to be funds which are going to do well. But on an aggregate basis, if you follow our recommendations, there is a better chance than not following a process of doing well, right? So this is an important point which I wanted to highlight about what should be your expectations, right? So please, I hope I'm able to set your expectations proper. It's about setting up a process, giving a repeatable, consistent process, not about beating every possible benchmark at all points in time. In general, I believe that over medium to long term, our portfolios are going to do better than the benchmark, but not every fund is going to do better. Great. Thank you very much for this. I think this was very important for me to share with you. And it's a relatively shorter presentation today, right? Because I think broadly, I've explained to you about what our process is. Now, let me take another 5 minutes to explain what are we doing on the debt funds, because what we do on the debt funds is completely different than what we are doing on the equity and hybrid funds. Why? This is the reason why. Now, let me talk about the philosophy of our debt fund selection process. The philosophy here we follow, I'm sure many of you have heard about this thing, is SLR. What is SLR? First of all, I'm concerned about safety, right? It is a first measure, not one of the three measures, right? So for me, the first parameter while I'm suggesting a debt fund is safety, because in our understanding, people who are investing in debt funds are not looking at even short-term or medium-term volatility, right? Forget about long-term volatility. That's definitely not they're looking for. Number two, liquidity, right? Because I see most people comparing this with FDs and bank deposits or savings account, etc. And return, after ensuring they are adequately safe, after ensuring they're highly liquid, then we think about returns. This is a philosophy which you follow in our fund selection process for debt funds. What does it translates into? So we are looking at only those funds where the duration range is from 1 day to 3 years, and I'll talk about what are those specific categories, right? Highest focus is on safety and predictability. And then what are we not doing? So third point is the most important point. We are avoiding long duration or credit risk funds. Long duration fund, why? Because in the short run, nobody can predict where the interest rates are going to be, and the damage to the portfolios can be very high. So we are avoiding long duration calls. If somebody wants to invest for long term, I think the better idea should be investing into hybrid funds or equity funds, not income funds or dynamic bond funds. So when I say long duration funds, I'm talking about long term gilt funds, I'm talking about income funds, I'm talking about dynamic bond funds. And credit funds, I'm sure all of you know what credit funds broadly are. The funds which invest into, let's say, AA rated paper or below in general, we are avoiding. My focus is, as I mentioned, duration range 1 to 3 years, and I'm looking at A+ or a top rated portfolio And finally, in this case, my bias is towards large fund houses as only when it comes to debt, just because of the size they manage. It is, if at all there is any problem, they're able to manage it well, right? What happens in this case? So there are about 200, I'm sorry, 441 debt funds out of entire 17 categories. So as all of you might know, there are 17 categories and we are suggesting funds only from 5 categories. Then the total number of funds which we have selected broadly from the categories are 158, and total number of recommended funds are only 15. So this document is available with my team, or I will also share this document with you. But this is our debt fund selection process.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.